Good evening and welcome to the University of Manitoba's Tuesdays with TD webinar, Homeownership, helping you get ready for your first home and buying a home in the current market. My name is Tracy Bowman. I'm the Executive Director of Alumni Relations and a very proud University of Manitoba alum. Before we begin, I'd like to acknowledge that the University of Manitoba campuses and research spaces are located on the original lands of the Anishinaabe, Aniniwak, and Sinuwak, Dakota Oyate, Dene, and Inuit, and on the national homeland of the Red River Métis. UM recognizes that the treaties signed on these lands are a lifelong enduring relationship, and we're dedicated to upholding their spirit and intent. We acknowledge the harms and mistakes of the past and the present. With this understanding, we commit to supporting Indigenous excellence through active reconciliation, meaningful change, and the creation of an environment where everyone can thrive. Our collaboration with Indigenous communities is grounded in respect and reciprocity, and this guides how we move forward as an institution. Well, thank you for joining us and making this event part of your day. Tonight, we're going to be diving into all things home ownership and preparedness, from should you rent or buy, how much do you need for a down payment, how much can you afford, do you need a pre-approval, what type of mortgage should I get, this and more. There's lots of questions that will be answered during today's session. Before we start, a huge thank you to TD Insurance, a University of Manitoba affinity partner, for their sponsorship and leadership of today's financial webinar. As you may know, TD Insurance provides discounted vehicle, home, and travel insurance to alumni, students, staff, and faculty, and direct investing opportunities through TD Wealth. And very soon, we're going to be launching a small business insurance product that those of you who are entrepreneurs, budding entrepreneurs, or know entrepreneurs can really take advantage of. And you can check out this and many more opportunities and perks and benefits on our website, umanitoba.ca/alumni. So now let's meet our presenters. I'd like to introduce you to Daneeka Rico, who's a senior financial planner with TD Wealth, and Steve Verry, who's a mortgage specialist with TD Wealth. And both have worked in the financial services industry for over 15 years here based in Winnipeg. Now, Daneeka is often a presenter for our Tuesdays with TD series, so she's a familiar face to many of you. And Steve was with us last season for this session also on home ownership. So welcome, Daneeka and Steve. And now over to you.
Awesome. Thanks so much, Tracy. And thank you guys for spending your Tuesday evening here with us. Steve is going to do the majority of our chatting here this evening. I might jump in for a couple of slides when it comes to the first home savings account and a couple of other pieces here. We've got about 31 slides, and we want to make sure we've got a lot of time for questions at the tail end of this for you, because we do find that that's where most people get the most value, is if you take the opportunity to ask the question that you are thinking about, because the reality is if you're thinking it, somebody else probably is too. And so be brave, be bold, and ask the question. So for that reason, we might go through a couple of these slides relatively quickly just to make sure we've got that time. So if you feel like we went through something too fast, ask us to repeat it or go back in the question component there. But before we get through the slides and talking about home ownership and some of those key pieces around making an offer and what that's going to look like, Steve, can you start us off by just sharing a little bit about what's going on in the markets right now? What are you seeing in terms of, is this a seller's market? Is it a buyer's market? Is there bidding wars? What's local in Manitoba? I know sometimes in the news we hear things and we hear it for, Canada, but a lot of the time what's happening in Toronto and Vancouver isn't relevant for us here in the prairies. So could you maybe start off by sharing a little bit of that information before we jump into some of the mechanics of home ownership?
Absolutely. And again, thank you for having me on the call today. I look forward to giving you as much information as I possibly can. But right now, in short, I would say it's competitive. So it's more of a seller's market per se. I do have a lot of clients right now sitting on the sidelines, pre-approved, writing on, I guess, multiple different properties because they're not able to win an accepted offer. They're not the sharpest offer sometimes, and it's just quite competitive. I think it's really and it's been a problem like with inventory. I talked to my realtors and builders, and there's just not a lot of inventory, and it's on all price ranges. I'm finding now too. I got clients that are looking in the 400 to 500,000 range. and we're waiting for that inventory to grow. So there's a few more buyers than there are good listings, I would say, in all those price ranges. And I just got an email 10 seconds ago that the clients did not win on a property tonight, and it was their, I think, ninth offer on a house.
Oh.
So that's local to Manitoba. Not every offer is like that, but there are usually multiple offer situations. So that's why I say the word competitive. And that's the environment. And we've been in this environment for a while. Some months it's a little worse than others, but we're not the worst market. I'm hearing still in Alberta, there is, I think I had a client that wrote on an offer, that was a week ago. There was 17 offers on a house in the 750,000 range. And that sounds crazy to me. But here, multiple offers is happening a lot. So people are calling me a lot of the time what we can do to sharpen that offer. And that's a little bit of a slippery slope. And a lot of times realtors will be in there for that help. But a lot of people are actually asking if they can write sometimes on houses that they're looking at with no conditions, no financing condition. And
Oh.
I can't say yes to that. So
Mhm.
it's a protection to them for and a protection to the bank. Again, when someone's pre-approved, which we'll talk about in a few minutes, we really haven't underwritten a property. So when a deal
Mhm.
goes live and someone writes on a property, they should be writing subject to financing of a few business days in there where we can actually submit the actual offer to purchase, evaluate the property, and or let one of the insurers do it. So competitive in the buying situation right now in Manitoba for sure.
Mhm. Well, thanks for sharing that. There's so many different things that are running through my mind that I want to bring up and talk about, and that's really relevant to this, but I'm going to hold my tongue because I know we've got lots of slides. And if this is something that you guys want to talk a little bit more about, mention it in the comments and we can circle back to it at the end of the presentation. But certainly something to think about as you're thinking about home ownership. So I'll move along here to the next slide for you, Steve, and let's just jump right in.
Yeah,
Are we
so
ready to buy?
So basically, yeah, are you ready to buy? So this is kind of the big question that people need to kind of, figure out first, to help support your decision making. I would say sometimes to certain clients, and I'll be honest, a lot of people don't come to asking me if they should buy or rent. It's usually a preconceived. Honestly, I don't even think I've had that question in a while.
Mhm.
I'm sure there are circumstances in life where renting makes sense. I'm sure I rented before I could home own. I actually didn't have the down payment saved. I probably didn't have a high enough income in my first early stages of my career to get a good home. So I rented for a good 4 or 5 years as well, saved up some money. I was splitting rent with a person for a while, one of my best friends for a couple of years while we were just finishing our school. So there's reasons for renting, but there's opportunities and strengths to both decisions, depending on your specific personal goals, I would say, what priorities you may have at the time and your timeline. I would say ask yourself what's important to you at that moment. What's your overall goal and how does the decision fit in your priorities? And the decision is not to take home ownership comes with, I would say considerable financial commitment. When you buy a home, it's a long-term debt. You are going to be paying it down for years to come. So it is something that, you should meet with your financial advisor and family, talk, leverage family and other people's experiences too, I would say as well, and trying to make a decision if you're ready to home own. But really, your lender will be the one you go to where we can actually look at your financial circumstances and again, get into a pre-approval and look at what you can do and advise you on that with the current objectives. Um, so I think the next slide question is to ask, will this property be your starter home first off? So I see many, many clients that are buying homes. They come to see me. We get them pre-approved to buy a house. They're only there for 3 years, 4 years, 5 years. People, sometimes they want to get a starter home, something that they can move into, maybe make a small investment over the years to have in there. And have a piece of something of their own. And then they move on to their next home, and then that could be their forever home. Some people now I'm seeing more than ever people are actually, buying the forever home sometimes right off the bat. And there's something to be said about that. Maybe someone doesn't want the headache of moving. Their, a job situation in Manitoba is going to be there for long term. So I'm seeing a lot of people, first time home buyers are building brand new homes. And it's just a new thing now. Where do you want to live? I would say, do you want to live in the city, suburbs, in the country, having more land, things like that to consider? And different types of properties. I would say some people want to get a condo. Condos can be a good idea for certain people that don't really want to up with the upkeep of the home that you would have. Like this morning, I woke up, had an hour of shoveling because I have a massive driveway with a double detached garage at the back with a shared driveway, and there goes my hour at 7:30 in the morning. I'm trying to do it before we run the cars out. And so there's little things like that when you own a home. Or do you want to have a single detached home, a regular home, single? Detached could be like a bungalow, two-story home, and also the consideration of building your home. And that conversation, I won't go into too much detail about building a home. There's different options. It's a little bit longer process and can get a little bit complicated sometimes. And that's why, I won't go into detail now. That's not as common. A lot of first-time home buyers are usually buying more often, I say, a resale home, an existing home. But some people are going to buy their first homes as brand new homes, so it's something to consider as well.
Yeah. So
Um,
almost a key takeaway on that slide would be, write down a list of what matters to you, right? What are your top priorities in a house? What things are you willing to give on? What things are you're not willing to give on? And then from there, really start looking at, do these check your boxes, right? Would that be fair?
Yeah, absolutely. Like looking at location, being mindful of the surroundings a little bit as well, the community, the neighborhoods, what amenities are in the area and things like that when you're looking at wanting to make a purchase of a home. And will the property require immediate upgrades? That's something I also talk to people about sometimes when they're looking at a home. Sure, a lot of homes that people are buying, they're not built 2 years ago. So sometimes they're going to need some upgrades, and it's something to consider when you're looking at the home that might need new windows, a roof in 2 years' time or 3 years' time, a furnace. These things are, stuff that your realtor will help you look at, I would say, obviously, and give you advice on. But it is important to look at those aspects when you're buying a home, I would say, for sure.
Yeah. And I'm going to take this next slide, Steve, if you don't mind,
Of course.
because Steve and I are going to have very different answers to this question on how much you're able to afford. So, a mortgage specialist or a banker is going to sit down and we're going to run your numbers and we're going to look at, what's your gross income? So what's your income before taxes? And what are your current credit expenses? And in addition to that, what do we anticipate this house to have in terms of property taxes and utility expenses? And then we're going to look at a ratio. And that ratio is going to say, great, you need to have, what is the TDS? About 40%
About
total.
40%. Yeah.
Yeah, about 40% of your income, gross income, cannot, no more than that, can exceed going towards your property maintenance and your debt expenses on an annual basis. But that does not factor in your life and who you are as a person, your lifestyle. Do you have children? Don't you have children? What are your expenses? And so, I can reflect on a particular scenario with my sister-in-law about 15 years ago. She went into the bank. She got a pre-approval and they said, hey, great, you can buy a house worth X amount of dollars. And so she was super pumped. They went out, they bought the house, they had the mortgage payments. She comes back to me about 6 months later and she says, Daneeka, they said I could afford this and I can't afford it. And it's really, really, really hard. And I said, sure, they didn't factor in that you have to pay daycare every month. And they didn't factor in that your kids have tutoring and medical expenses. And so it's really important that you understand what you're comfortable spending for your housing costs. And so generally, as a financial planner, there's going to be the number that Steve says you can afford. Then there's the number that you say you can afford, and we work backwards. So a lot of the time I'll say, tell me what you can afford on a monthly basis. And my client will say, well, I can afford $2,000 to go towards, or in this case, $2,150 to go towards my housing cost. Well, that's not all mortgage. So you first back out the utilities and the house insurance and the condo fees and the property taxes, and we put that aside. And then we say, okay, well, what's left for the mortgage? And then that number is going to say, okay, well, $1,200 can be for your mortgage payments. What does that get you in terms of house? So if we looked at a mortgage with a $1,200 mortgage payment over a 25 or a 30-year amortization, what's your purchase cost? And then are you comfortable with that house? And if you're like, oh yeah, that's a price range I'm comfortable with, great. If it's not the price range that you're comfortable with, are you willing to give up other things in your lifestyle to live in that house that you want to live in? Or do we wait and save more? Or do we put down a bigger down payment? Like, there's so many different conversations, but understanding your budget and how this impacts you is going to be a really good clarity question to make sure that you are not house poor and stressed out in your life, feeling like you made this payment that you can't afford in the future. The other piece to note is that it is not just mortgage payments. So most people correlate renting to a mortgage payment. I'm going to buy a house and I'm going to have a mortgage payment of $1,200 versus I'm paying rent to somebody in $1,200. Every expense that you have, be it the furnace goes or the roof needs to be repaired, is coming out of your pocket. So you need to be saving for that and having a contingency fund to build for those repairs that are going to show up at some point in your life. So you can see an emergency fund of $100. Normally, I say you need about $5,000 a year for operating expenses to maintain your home. If you don't have repairs this year, it might be a $10,000 repair next year. Now I'm going to pass it back to Steve and talk about down payments.
Thanks, Daneeka.
Yeah.
Just to add one more point to that, what I would say is interesting when a lot of people come to see me that really are first-time home buyers and don't realize it showed that mortgage payment, wherever that comes from, at $1,200 in that example. But there is a stress test, and I think it might say that in a few minutes, but in Canada, when you go apply for your mortgage, yes, the average rate right now might be around 4% in the market today for most lenders to get a fixed mortgage. So, you think your mortgage payment will be built at that, and it is. But what we have to also do is we have to stress test that 2 additional%. So really, when we are approving you, we're inflating that payment so that you can possibly withstand, a change in interest rates in the environment to some degree, and that you can afford your mortgage if rates go up an additional percent or two over the coming years. So, I do have people that are sometimes, surprised when they're like, oh, I should be able to afford a $500,000 home, and my income is this, and then we look at it and it's really around that 400, 425, 400,000 mark, because that stress test is what we have to do on every single mortgage we touch. So it really makes it a bigger mortgage payment that you have to show that you can afford, but it really would be based on the contracted interest rate that we're advertising. So just to add a little bit to that as well. Now we're on down payments.
Yeah. So what's the minimum down payment?
5%. So you can get a mortgage in Canada with any lender with as little as 5%. So that's a default insured mortgage. That being said, you do have to actually pay a premium for that. So when you put down less than 20%, that application is approved by a default insurer for being I guess we'd call it a higher ratio, higher risk mortgage for the lender. Whereas someone who puts down 20%, that's a conventional mortgage. So when you're looking at, putting down 5% or 10% or 15%, that's a default insured mortgage by one of the three insurers that we have in Canada. So automatically, when a person buys a home and we submit the application, it automatically goes through an insurer system, a computer system that will actually just approve the deal as well. And if you put down less than 20%, there is a cost calculation that is added to your overall mortgage over the 25-year amortization. That's usually the standard contract that most people will take when they buy their first homes, and you can pay it off sooner than that too. So borrowers must demonstrate the portion of their down payment that has to come from their own resources, I would say. So really, like, someone can't go buy a home with a borrowed down payment for 100% of the down payment. You need to show that's come from your own resources. And there's different ways you can get that. So examples of, resources are bank savings, investments, a gift, or equity in an existing home. Some people take money out of a home they own as maybe their previous home or a rental home they may own, and they may refinance that home, pull the money out, and use that for a down payment. But gifts are actually quite popular. Cost of homes have gone up, so there's a lot of situations where I have a lot of first-time home buyers where they've saved some money, they're almost to that finish line, they're almost ready to go, and they have the credit and the income to be approved, but they may not necessarily have all the money. There's many, many times, at least probably a couple times a month, I'm probably doing a TD gift letter where immediate families helping children buy a house, and that's the reality, because houses are now over $400,000 on average in Winnipeg, and people need help. So that's very common. Where else can I say about that?
Your other things. So we also tend to think that it's a down payment and that's all we need, but there is that additional closing costs that you're going to come into for purchasing this home. So generally you're going to have legal fees, you're going to pay a lawyer to do up all your paperwork. You're going to have land transfer tax that you have to pay, and then there's going to be moving expenses. And so when you look at your costs, let's say, for example, I'm just going to use a really easy number. You can't buy a house for this, but $100,000. You put a $5,000 down. That's $5,000 as a 5%. You still need anywhere between 1,500 to 4,000, and I generally say about 3% as a closing cost to cover that. So you're almost doubling that down payment requirement when you're doing a small down payment for those additional costs that are going to come up. And a lot of people are surprised and they don't realize how much that's going to be. What were you thinking, Steve?
I'm really glad you mentioned that. It's actually mandated when you apply for an insured mortgage, the lender, at least TD, I'm pretty sure every lender has to do the same thing. If you're getting an insured mortgage, we actually have to see the assets at the time as well to cover your closing costs. The built-in calculation is 1.5% that we're supposed to use. It's not enough. So I like what Daneeka had mentioned, 3%. I use 2%, where that it could be your land transfer tax in Manitoba, your lawyer fee and everything all included. So I use 2% as a rule, and we're mandated 1.5%. So if someone comes to TD or RBC and they're like, okay, I got 5% down, I'd like to buy a house, you need to have that 5% plus that additional 1.5%. That is the minimum to show us in your savings or bank accounts to cover those costs to close the transaction. That's a really good point.
I'm going to take over a little bit here on that first home savings account because this is a pretty new product and a lot of people aren't aware of it. So historically, you would either save for your down payment in a bank account, in a non-registered investment account, maybe your tax-free savings, but most commonly we were using RSPs to save for the home. And there's some benefits to saving for your house using an RSP, but there's a lot of disadvantages there. You have to repay the money you take out of an RSP within 15 years to put it back in there so that you don't get taxed on it. And so a couple of years ago, the first home savings account was introduced as a new vehicle where we can save, and it's a pretty sweet gig. So you put money in. You can put up to $8,000 per year, provided you're over 18, and that's going to be a tax credit. So if you make $100,000 a year, you put 8,000 in, the government's going to say you made 92,000. You're going to get a tax refund on the 8,000 that you contribute in there. And then every year you build additional accumulation room up to a maximum of $40,000. All of the money that's growing in there is growing tax-free. So it's kind of like a hybrid of an RSP and a TFSA in that you put the money in, you get a tax rebate as a result. It grows tax-free, like a tax-free savings account. And provided that you buy a house, and a qualifying house, which just means you're a first-time home buyer, you can take that money out and you never pay income tax on the growth. You never have to pay that money back. So you got a tax refund at the beginning. You grew this money tax-free for a number of years. You took it out to buy your house. It's a pretty sweet gig. And so I encourage you to use a tax first home savings account to save for your home. If you have not owned a house in the past, this is definitely a vehicle that you should be considering and having a conversation about. Okay.
And just to add to that, I do like the non-repayment aspect because I was one of the people in Canada who bought my first condo years ago, probably 15 years ago, pulled out probably the maximum back then, which might have been 20,000. I think it's 25 or 30 now, but out of my RSPs. So I use that as my down payment and closing cost to buy my first condo. And what is so great about this product, I would say, is that you don't have to worry about paying it back, really.
Yeah.
That's huge. So as my withdrawal was, I had to kind of over contribute and save more over the years, and you don't have to worry about that when you pull it out for your house, which is really nice.
We're going to jump over to buying a home. I'm going to skip over what is a mortgage, if that's fair.
Yeah, we covered this. Yeah.
Yeah, you want to talk about it?
No, we just did actually.
Yeah, we just talked about it.
Types of mortgages, sort of, so that's fine.
But I will get you to talk a bit about the different types of mortgages that we have. And so I'll leave that with you.
So, I mean, basically, there are two major choices when you're getting a rate, two different types of terms. So when people are getting a mortgage, you have to negotiate your interest rate of what kind of interest rate you're going to take for your first, let's just say 5 years in some cases, which is quite popular. But you can take a different type of term, which is your set rate for the mortgage for that period. So you pay the interest according to that term. The simple sleep at night option, I'll call it, are fixed terms. You basically go in and you lock into your interest rate. So today you might be looking at a 5-year fixed mortgage today, and let's say it's 4.25%. That means for 5 years, that's your interest rate, will not change. That's what you're going to pay on your mortgage, and that's how your mortgage is calculated. What is nice about that, like I said, is that you actually don't have to worry about interest rate fluctuation. Variable has become actually a pretty unique mortgage and quite popular in the past few years. Actually, it's been popular for probably a lot longer, but it's actually been a unique topic of conversation in the past 3, 4 years. So a variable mortgage is also usually a 5-year term, but it can fluctuate based on, I guess we'll say what the economy and Bank of Canada does, and maybe Daneeka can speak to that, but it really is a rate that will fluctuate throughout the term. And you want to hope that interest rates will remain low or continuously go lower to take advantage of being able to pay more principal on your mortgage. But a couple of years ago, we went through something called COVID, and interest rates kind of went in an interesting direction. I fielded very many phone calls of not even my clients, just TD clients who took out variable mortgages wanting to look at options because interest rates rose 2 to 3% in that time frame. Actually, about 2%, I think. So people who took out mortgages 3.5 years ago, some of them took them out at 1.5, 2%, and their mortgage went to like over 6%. So I mean that was a bit of a unique situation. And now we're back, and those variable rate mortgages are down to just over 3%. So people stayed steady. It has come back, and now they're reaping the benefits. And I don't know if Daneeka, you have anything to say about, how the variable rate mortgage works with the market a little bit too.
I do, but I'm cognizant of time. So I'm going to put that on. If you guys are interested in hearing a bit more about variable rates, I definitely have some thoughts about it, and you can throw it in chats and we can chat about it in the questions and answers, just because I can get pretty long-winded there. Does that sound fair?
Absolutely.
Yeah. Okay. Steve, tell us about a pre-approval. What is this and why do we need it?
Yeah, so I mean, basically, the pre-approval is like really the first point usually, and the best point to start your home buying journey. Basically the application will give you a realistic value of what you can comfortably afford in a framework of price points when working with your realtor. So we can come in, we can sit down, we can take in your income confirmation. If you get paid a salary, we'll calculate sort of what could be your potential ceiling in most cases. Essentially, that's what I'm doing today is when we meet with the client. I will actually do their pre-approval. We'll check your credit and we'll make sure the credit's good. And then we'll look at your income and your current debt obligations you have now. So if you have a loan payment, we need to take that into consideration. If you have a Visa card with a balance, all those kinds of things are factors. And we'll basically find out, yeah, what is your ceiling, I call it. And then you and your realtor can kind of look and start looking at homes after we get the pre-approval done and give you the advice. And then once you're, find the right home, you'd be making the offer to purchase with the realtor.
I think that one thing to note is that some people don't get a pre-approval and start looking, and then you fall in love with a price point that you can't actually afford. So if you start looking and you're looking at houses that are $750 to $1 million and you start falling in love, and then you go see Steve and you get a pre-approval and you can only spend 500 or 600,000, man, is it hard for you to find that house that you're really going to enjoy, because you're going to be comparing it to something else. And so, going in and getting a pre-approval early helps you curb your expectations, or maybe it makes a decision on, I'm waiting a little bit longer if it's not the right house or price point for you.
Yeah. It's just a good step to getting ready and being it can be a stressful transaction sometimes, especially in this market right now when you're in competing situations. And if you know that ceiling and it's done right, at least you kind of know where you can go. And that's also too, the last thing you want to do is have an offer accepted. And if you hadn't really had a due diligent pre-approval done, then you got to run around and get documents pretty quickly sometimes. And it's best to do that well ahead in advance. So.
This one mentions mortgage prepayments. And so you can certainly pay off your mortgage sooner than the 25 or 30 years that is set in your original mortgage agreement. And different banks have different rules, but know that there is different functionalities where you could pay off or make additional payments to your mortgage if that's something that's important to you over time.
One thing I would add to that as well, Daneeka, is that not only, the prepayment privileges, but also being able to make changes in your life when you're in mid-contract. A lot of the major banks and TD were really good about being able to help facilitate people moving from one property to another when they're in mid-contract. So it's called portability. So if you have a 5-year fixed mortgage and, you're penalty could be to break that mortgage in some cases, you don't have to break it. If you go buy another house, there are ways we can transfer that over. So we have really good privileges so that you can avoid having a penalty and getting into your next home while you already were in contract on your previous mortgage. So something I do a lot of. So good to know that.
Yeah, let's talk about your home buying team. So who should be on your team? I mean, there's you.
Me. Yeah, so absolutely your lender. I mean, basically there's mortgage brokers, there's mortgage advisors everywhere. But yeah, basically we were going to assess the situation and we're going to find out and give you advice on what you're comfortably able to purchase so you can kind of go shop around and make your offer with your realtor and walk you through the process and handle that when the deal goes live, of course. And your realtor. A realtor is very important. Having a good realtor is a really important aspect, especially for first-time home buyers. I work with some of the best in the city, and I think it's a really important aspect. Someone who will sit down with you, find out, what are your needs, what are you looking for, and providing you that advice, and maybe someone who knows things about what to look for in homes. I had a pretty good realtor when I bought my house, and I always remember that like they could walk in and like a certain smell they could know right away if it was an older home. And it was probably something that we should be walking around spending too much time on. And I always remember that. And next would be your inspector. So this is something I don't really deal with a lot, but I do see this a lot. When people are buying homes, a lot of people want to make sure they're structurally sound. So the buyer and the realtor will sometimes negotiate in the offer to purchase, subject to confirmation of a home inspection being satisfied. Very common. Well, I should say in the resale environment right now, I said the word competitiveness earlier. I'm seeing people that are not actually writing that in there because there's 6, 7, 8 offers on a house. And if they just go and buy it, they'll win their offers, which isn't a great idea, but it builds. I would say in builds, that's actually also another good thing is builders and the realtor will get access to the home throughout the process, sort of to go do walkthroughs and things like that. So that's always a very important aspect there.
Yeah, I do want to spend like 2 seconds on here. And the reason is you mentioned competitive environment. And so generally the more competitive the environment, the less conditions you write on your mortgage. And, my first house that I bought was back in 2010 and it was a very competitive environment then. And so I had to ensure that I didn't put a lot in there. But condition to financing obviously critically important to make sure that not only are you approved, but that the house is approved for the purchase value. Because sometimes it can happen where you put an offer in and the lender says, well, it's not actually worth that much. Home inspector is one of those ones where if there's multiple offers and you put a home inspector on there, you're likely not getting picked because it's one other loop that the seller has to go through and wait for that condition to be removed. However, I have bought in homes, many homes. And man, I wish I would have used one several times. This summer I had to spend about $100,000 in foundation repairs. And my realtor told me, oh, you're good when I originally bought this house. And so these were there. And had I used a home inspector at the time, I likely would have not bought that property. So there is certainly value in having this. It's just a matter of, are you willing to see your offer be passed up as a result of that? But sometimes if the offer looks really good, maybe there's some things under the hood that you want to get looked at. So I just wanted to say that there because it's important. Your last person on your team is?
You're a lawyer, real estate lawyer. So there's many real estate lawyers in Winnipeg, but yeah, you definitely need one to handle the actual securing of the mortgage to land titles if you're taking out a mortgage, and also clearing all the liens on the property from the previous owner, and also too, like even just reviewing the offer to purchase. Always says it right there. Like I got a lot of people that buy homes privately, and they're like, "What should I write in the offer?" I'm like, no. Like I don't really. You should be protected. You should go talk to a lawyer. You should sit down and sometimes that changes the scope of the transaction and things like that of what to be putting in the offer. I just had one a week ago where a client was trying to buy a house and didn't know where to start. That was a very important thing for that person to go to a lawyer and get some advice tailored to that, with the condition of financing and things like it. So it's very important. Yeah, I'm not sure what else to say about a lawyer. I think that's pretty much about it.
Good. Yeah. Okay, so we've got our team, we found our house, we're closing the deal. Now we finalize our mortgage. So what does that look like?
Yeah, so when we finalize your mortgage, sorry, give me 1 second here. I had some notes. I want to make sure I hit everything. Yeah, basically, when you buy your house, the offer's accepted. What I do is I usually have a phone call meeting or an in-person meeting. We go over the actual mortgage contract signing and everything, which is, and then looking at options with the mortgage, like insurance, which we'll talk about in 1 second. I should say life insurance and critical illness insurance. And then once we're done, you sign with the bank the cost of borrowing. All we do is we basically then actually electronically send it to your lawyer. They get it on a portal system, it's called, where they get the instructions. They meet with you. You bring in the rest of the down payment outside of your deposit, and you go finish signing the legal title work with the lawyer. And then it's official, and then you wait for your possession date, and you walk into your new home. So it's pretty much as simple as I'll make it.
Yeah. The big key that people get confused on is that you're signing all of the mortgage arrangements with the lawyer. So other than the cost of borrowing document you sign with your mortgage broker, all the actual rules on the mortgage and your payment structures, etc., are being signed with your lawyer at that date. And you're bringing your draft to them, and they're going to be the one who facilitates the money transfer between institutions, the seller and the buyer. You mentioned Home Protector and that's life insurance and critical illness or potentially disability. Why is this important?
Yeah, so well, to me, I mean, when I talk to my clients, I always ask to see what kind of, coverages they may have. But basically, it's the biggest debt of someone's life usually. And if you have a family or you want to be protected yourself, in an unforeseen circumstance, you definitely should have a conversation with your mortgage professional about it. So usually most lenders will offer life insurance. So if something happens, God forbid, to you or another borrower, like, me and my wife, we're on this house. This is our primary home. We both have mortgage insurance on, and we have other insurances too, outside of that mortgage. But it is important because if something happens to me, I want my family to be looked after. And in a very unfortunate circumstance, you kind of want to have, an easier life to some degree. And also, there's a living benefit insurance called critical illness. So I call it living benefit. Critical illness, like a massive heart attack, cancer, life threatening. These are things where you get a benefit for having the coverage and you're still living even though you've been diagnosed with such an unfortunate circumstance where TD Bank or the actual in lender, they will pay off your mortgage in those respects if you have the insurance. So very, very powerful. And I've had clients that have had their lives changed, who have had a couple heart attacks. There's got to be at least 5 or 10 instances in my 10 years of doing this where people contacted me. I had someone who contacted me, unfortunately, a couple months ago, and they were asking from 3 years ago if they applied for the insurance, and the person was off work for about 6 to 8 months already, and they had a massive heart attack, and trying to make ends meet, and didn't take the insurance. So it was a tough conversation,
Yeah.
but very important.
I had a client recently where the husband died unexpectedly, and many conversations had over the last couple of years around wills and estate planning, life insurance, and he just never took action. And so the wife came in and says, "Well, doesn't he have insurance on this mortgage?" And I said, "No, he doesn't." And so, at the end of the day, she was on the hook for that, and there's going to be a significant life change as a result. So certainly something that's important, both while you're sick and recovering, as well as if you're leaving somebody to take care of these life expenses if you were to pass. All right, so we talked about the home ownership. We talked about all these different pieces. Now you're a homeowner. What do we have to do? Oh, I'm leaving that for you, Steve.
Oh, I'm
But
sorry.
I can answer that question. So you're not done. Obviously, there is going to be things that come up in your house, and generally we say the first 18 months you may have home buyer's remorse. Like you might come into this home and just be like, "What did I do?" You're going to find the things that you didn't see when you were doing the walkthroughs. There is going to be repairs and maintenance that show up in that first 18 months. Be prepared for it. There is costs that you did not anticipate that are now showing up. And so it's really important to remember that you want to complete the repairs. You want to make sure you're saving for those repairs. And certainly, if you ignore the repair, it's not going to go away. So making sure you take care of things sooner than later is certainly going to help you. But having an action plan and making sure we're prepared for those unexpected expenses is really important.
If I could add, if I could
Yeah.
add one thing to that, there is a lot of people that are actually going into homes and they just don't have that huge safety net when they're going into the home. And it is what it is. There's people have enough to get in. They just maybe it's early in their workforce. So there is a program where it is very useful and I use it a lot and my clients use it a lot, I should say, where you can do a purchase with a small down payment. So you are able to buy a home with 5% down, but also apply for renovations to be added to the mortgage at the time of the purchase. It's a unique transaction. It is something that I probably do once every couple months, but there are people that are buying homes and they do need work right away, and they may not necessarily have that $7,000 and may not be able to save for that for some period. But the government, or I should say CMHC, the default insurer, they do allow for purchase with improvements up to certain standards. So you could do that and get it added to your mortgage by getting a provided quote. The only thing is that you usually need to finance that a little bit on your own before the money's released to the lawyer. So it is a very, very popular program. I use it, I'd say once or twice every month with high ratio mortgages. And it is a unique thing that a lot of people don't know about. They think that, well, I only got 5%. I got to wait, 5 years to do those windows. Well, you can actually get that tacked in at the start if you get the provided quote from a renovator to do it, and you can get it added to the mortgage. So kind of neat to know that.
Awesome. Thanks, Steve. And now it takes us to our last slide here, which is questions. And so Tracy, I'll maybe let you be the moderator here and see if we've got any questions that have come in throughout this presentation.
Thank you. That was an amazing presentation. Lots of great info. We don't have a question yet, so I'll give everybody some time to ask questions, but I have a question.
Yeah.
So I actually just recently I bought a house last June, and I'm in it right now. And so one thing that I'm interested to know is we worked at you were talking about your home ownership team, which I agree, critical. We had a fantastic lawyer, great bank, and most amazing agent. And so I'm just wondering how many house purchases you're seeing in Winnipeg that are using an agent. Because for a time there was, I'm forgetting the name of the company, I don't see it anymore, where it was really just a do-it-yourself type of everybody can be a broker, everybody can be an agent, right? Yeah. And I'm not seeing that I don't see those signs anymore. I don't know what that means. Maybe I'm just not noticing it. But I'm just wondering.
It seems to have fizzled out a little bit. The ComFree, I think, was maybe the big
yes, that's what it is.
A lot of No, that's like non-existent anymore. So people are doing it privately. I mean, I think honestly, it's just residential offer purchase. Someone knows someone, and it's not that common. Most of the listings I'm seeing that if there's a resale transaction are done with agents for sure. Absolutely.
That's really good. So people are protected and they know what they're getting into, because it's filling out the paperwork is not easy. There's lots in there that things that just don't make sense to if you're not in the business. It's hard to understand.
One caveat I would say, there's 300 agents in Winnipeg.
Okay.
So there's a lot of newer agents as well. So sometimes I feel like having that experienced realtor can be really helpful rather than using, I hear like, oh, my friend just got his realtor license. And, I'm not saying that's wrong, but especially in this market with a competitive environment, having that realtor that may have been in the business for some time, has that reputable name, when they're doing offer night, I am hearing that, oh, you know what, this buyer is dealing with this agent, that's a good client. Like, because they're dealing with that agent. It's actually almost a selling feature to some degree. So something that was kind of something I learned not too long ago by talking to a few agents. So a lot of agents, and there's only a small percentage of them doing most of the business in Winnipeg, actually.
And we had to sign paperwork as well with her, just to say that she would be her agent, and also we agreed to her fee, and which I'm sure some people are thinking, oh, that's a 4% or 5%. That's a lot of money when you add it, right? Is that something I can just get rid of and not have an agent, right? Especially depending on the price point you're looking at.
Well, yeah, when you're selling, for sure, 100%, you are going to be having your home marketed, and you're going to have a realtor, and they do have that cost that you do pay when you're selling a property. When you're first time home buying, you're not really paying that. So what's interesting is I tell people, because you're buying and that agent's going to split the commission of the other person. So I find having a really good agent as your first home is a really opportune time, because you're not going to pay a commission on that. You will in the 5 years later or whenever you decide to sell it. Absolutely. But that's what you're kind of paying for. And there's some of these agents and photographs and how they market homes. It's pretty amazing. As you can see, maybe, if you've been looking, some of the price ranges that, homes are going for are going considerably over your asking prices,
Right.
which is another conversation. Asking prices, sometimes the listing price is not really the
Right.
true asking price. So people say, oh, I went for 100 grand over asking. Well, really probably went 40 or 50 grand over asking because it was listed lower. So it's kind of that game that's being played in certain aspects too, and how you list a property, I think.
Great. Yeah. And that's a whole other webinar too, I'm sure, right? So we've had a question that's come through and it's on taxes. The question is, do we pay taxes when we buy a home? And do we also pay property taxes every year?
Yeah, great question. So if you're buying, and Steve, correct me if I'm wrong, but if you're buying a new build, you're paying GST on that new build.
Correct.
Okay. If you're buying a used home, there's no GST on that property because it's already been paid, and there's no PST on the property. So it's simply, if you're building a new house, you are going to pay GST. It's built into your mortgage price, right? Yes.
Correct.
But if you're buying a resale home, there is no taxes. Property taxes, on the other hand, you're going to pay every single year. That's going to be issued by the city or municipality that you live in, and they are going to be paid yearly. You get a bill. You can set up on something called tips here in Winnipeg, where you can pay it monthly so that you're not surprised throughout the year. A lot of people will do that so that you can budget accordingly. But that property tax is essentially paying for your front street, your lights on the street, your roads, your snow clearing, those kind of things. So necessary evil that you are going to have to pay.
This is program is great though. It really allows you to plan accordingly rather than just one lump sum. So you know what your monthly costs are.
That's right. Yeah. Any other questions in there? Or are we
Not
pretty
yet.
Oh,
No.
we're pretty
So
quiet.
sorry. That's not true. One just came through as you said that. Okay. Okay. Great presentation. I wanted to ask about having debt and if that affects the chances of getting a pre-approval. I have a government student loan debt that's interest free. And if I'm wanting to get a house, does it mean that I have to pay off my student loan first? What a great question.
That is a really good question. It is a factor, but does that mean you can't buy a home? No. It is a consideration, but the payments are quite low. And usually most lenders have even if you're not on repayment, we do forecast, I think, a 1% payment of the loan into your debt service. So 1% of basically whatever your loan is, if it's $10,000 or $20,000. It's not a huge amount. But yeah, I have many clients that are doing mortgages on their first and second homes, and their student loans are still there because they're such well set up loans with really good favorable payment plans. There's not a huge incentive to pay them off, but it is a little bit of a factor in terms of your debt service that we have to do. It's not a negative factor, but it is a factor. A negative factor would be just like more so a derogatory credit that isn't being paid as agreed, like a credit card that's overdue or something. Very common. People have student loans after their but into buying their first home, and I'm still doing mortgages for people in their second homes, and they still have a student loan of a few $1,000s owing. It's not a big deal at all. We just have to factor the payment in.
Yeah, I think that, one of the things to think about is, remember that TDS that we were talking about at the beginning. So you look at your total income. So if you make $60,000, and then you take those student loans and, your payments, and you multiply it by 12 as an example, or multiply 1% of the outstanding balance. And that's what we're saying you have to pay every year. And then if you have no other outstanding debts, you essentially take that and divide it by your current gross income. And that's your total debt servicing right now. And then we want to make sure that that number is less than 40% when we factor in your home ownership. Something that impacts your home ownership more is if you decide to go buy a brand new car and you're like, oh, I love this car. It's so great. My payments are $200 weekly. Well, that's significant, right? Like that's $800 a month. That's going to have a huge impact on your ability to borrow. And so when you're making life choices, you want to consider impacts on cash flow and impacts on that debt servicing. So if I wanted to buy a house and I wanted to buy a car, I'm probably buying the car first. And then maybe, if I'm single, I'm having my friend live with me and she's paying me rent, which is great. So she's covering my mortgage payment. So I know confidently that I can afford this car. Now I'm going to go to the dealer and buy that car because the dealer doesn't care. Like the dealer is willing to lend much more on my current net income versus the bank when it comes to my mortgage. And so now I'm going to get that car, provided I can cover all the payments and I'm not stressed out. I know this from my own personal experience because that's what I did with my first home ownership journey. So, look at what you want to buy and the impact on your total debt servicing. And you probably want to buy the most expensive one first before you go and get those other ones.
And that is a crucial comment you just made, Daneeka, because I actually have that as a blow up, I will call it, in a lot of applications. Not a lot, but it's happened at least a handful of times in the past couple of years. And, a client gets pre-approved and they think they're good, and they're getting ready to buy a house. And then at the same time, after they've been pre-approved for a month or two, because some people don't buy homes right away, they go get that new car. That's a no-no in my books. Don't do that. And I've had deals falling through. Someone wrote the offer and then they sent it to me. And then 4 months later, we're doing the application. And I think it just happened a couple months ago again. And all of a sudden there's $1,000 truck payment there. And can't be approved now, changes. And they couldn't.
Right.
So they said, well, it's pre-approved. I'm like, well, that's a point in time. You've had to made a material change. And I'll be honest too, like I actually right now with people that are struggling to get into the housing market, I find that may not have such a high income and early in their working stages. Sometimes if they're putting down and they're trying to be good and putting down 10 or 15% and maybe reducing that default insurance cost. Honestly, I've probably talked a few clients this past month into paying off their entire car loan for 20 grand and putting down 20,000 less on their $500,000 home because the actual cash flow of that $600 or $700 payment is way more greater for them than raising their mortgage payment $100 or $150 a month. 'Cause
Right.
that's what it entails. So really, sometimes you have to look at both angles. And I've had a couple instances where people are trying to buy their first homes in the $450,000 range, making 70 grand a year. It's hard. And you have a
Yeah.
$20,000 loan left over with a $600 payment, and it works. And that's what we do. We actually just condition for the loan to be paid out, and then they end up putting a little less down and gets them into the home and a better marketable home too for the future.
Mhm. We as a society are just being more conditioned to live with more debt for a longer period of time, is what we're seeing, right?
Yeah.
So, anyways, 3 questions have come through as we've been talking. The first one is, can asking for various pre-approvals at different lenders, can it affect your credit score?
Yeah, absolutely.
Yeah, it can. I would say that when people are looking and searching around, if you get pre-approved from a major bank and you're dealing with a professional, like it's likely being done correct, right? They should be, asking for income verification. They should be, making sure they check the credit and then doing the straight calculations and making sure that you're under that 40% ratio. It From RBC to TD Bank to Scotiabank to like the lenders, they're not going to have a variation in what you're approved for. And if there is a big variation, then something was done differently. If I ever heard that RBC was approving a client for 500,000, but I only could do 375, something is wrong. So, use the spidey senses. But yes, if you're doing the full credit application pre-approval, that is going to be a credit check on your profile. So you don't want to do that at 4 or 5 banks. I'd stick to the one, and then you could maybe, if you're looking at the rate differential, or like we said, the prepayment privileges and options that come with your mortgage, you can ask those questions of the lenders. And then you can make a decision about moving the financing if you want to, but I wouldn't apply in 4 or 5 banks pretty much.
Yeah, what happens on your credit score is like the credit score is very analytical. There's no thought and method behind it. Nobody's thinking and analyzing it and coming up with a score for you. The more hits that you have on your credit, the more it's going to impact your credit score in the short term. And if you use or if you go to multiple lenders, it essentially looks like you're searching for credit. It looks like you went to one place, got declined, went to another, got declined, went to another. Oh, you got approved. Oh, you want a different rate, you go to another. And so it drops your score overall because it looks like you're credit seeking. We don't know whether you got approved or declined. The credit, like Equifax or TransUnion, doesn't know, but they're making the assumption that you got declined, you're going multiple places. Now you're credit seeking. Now it's dropping your credit score every time you go in.
Interesting. Okay. All right, next question. Sorry, go ahead, Steve.
I was going to say, if you want a second opinion sometimes, sure, you can do it like a couple times. Like I deal with situations where like I do hear once in a while, this lender I went to, I'm not sure if this even makes sense. You know what? It really comes down to your advisor. There's a lot of different things that we can do with policies that the bank should all have the same rough access to them, but self-employed individuals, like sometimes I've seen people not be approved at one lender and then they come to me and I can structure it and make a case for it. We can look at the business financial statements if we want to go that far, if they own a company. So lots of time income can be perceived differently at a place, but you wouldn't want to check in more than one or two places if that was the issue.
Mhm.
Get the pre-approval amount and then move on, I would say.
Yeah. Okay. Um, let's talk about a cosigner. So the question is, what are the benefits and disadvantages of adding a cosigner to a mortgage? And then a
Right.
bracket says as a couple. So I imagine it's a cosigner for a couple, or I don't know, or maybe it's two in the I don't know. I'm not sure. But what about a cosigner?
Very common in my world. Especially again, houses are more costly nowadays than they are. Cost of living's up a little bit. So yeah, we do have the ability that if someone says, "Okay, well, if I only can buy a house with my income right now because I'm younger or I'm in my early stage of my career, and I want to be in this price range, so I want to be in that 400,000 range, but I'm only able to get a $300,000 house at my income. Can I have a cosigner to help?"
Mhm.
Absolutely. Basically, it's usually going to be a parent in most cases. It
Right.
actually has to be if it's an insured deal. It has to be immediate family members.
Or
Uh,
spouse,
Pardon me?
or
Or
spouse,
spouse. Or
couple, or
spouse.
couple,
Yeah.
right?
And
Yeah. A
and
couple.
for insured mortgage, yes, that's correct. And they could actually co-sign. So they could come in, add their application, they would be added to it with their income, and they would go on the application, the mortgage, and the title and co-sign. The only disadvantage is that like if co-signer needs to be removed in the future, there is going to be some sort of legal cost, which is like going back to a lawyer to change the title. But you also need to be approved for that too. So that's kind of a loaded question where people are like, well, when can my dad not co-sign anymore? When can he come off? Well, he just started a business. So I would say, I'd say you need to be a few years in because we need to see that with a good 2-year average of income. That's a very common situation. Um, but usually credit, if someone's credit isn't that great, but they need a co-signer for that reason, that credit score has to change. So once those variables are there, your lender needs to approve the option for the change, then you can go see a lawyer. And the downside would be is you do have to pay a lawyer again, which could be $1,200 or something. I'm not sure what lawyers are charging these days. Probably about $1,000 to $1,200, and so forth to do that. So
Yeah, I would say, if the bracket is couples,
Yeah.
certainly, if you both are living there and you're both contributing to the house, then it certainly makes sense to use both of your income on that application to support it if it allows you
oh,
to buy
absolutely.
a
Yep.
bigger house.
Yep.
If, one spouse doesn't have good credit or maybe they don't have a job right now, so they're not supporting that application, we might leave them off. When I think about this, I think about it from a financial planning perspective, and my head always goes to risk management. What happens if you get divorced down the road?
Exactly.
Well, if they're on the application or they're not on the application, then they're living in the house, and you're at least common law or your spouse, like you've got a
Right.
spousal arrangement or a marriage, then they have rights to the equity in that property, whether they're on the mortgage or not. So like
Oh,
sometimes people will stay off the mortgage because they think, oh, I'm protecting myself if we separate. Well, you're actually not, because you've got a common law relationship, and therefore there's some spousal rights that are kind of built into living in a house together. There's something called the Homesteaders Act. In Manitoba. So that would be one piece. When you're co-signing for somebody, or let's say you're pulling a parent on or pulling a sibling on to co-sign, the one downside that I can think of, and I've got a situation right now where my brother is saying, hey, I need you to co-sign for this mortgage. I'm getting a divorce. I need to be able to support. If I sign on that mortgage, it's going to impact me, because now if I go to upgrade my house or I want to go buy a car, it's going to look like I need to support his entire mortgage plus my mortgage plus my car payments. And can I support that application on my income alone if I'm not pulling him in to do that car loan application, which I wouldn't. And so, if you're going to co-sign for somebody or somebody's co-signing for you, they have to think about, do I need access to my income for a credit application in the future? And is this going to impact me and my ability to achieve my goals? So that would be one of the biggest downside risks in there.
yeah.
The other thing, and I don't want to go too trailing, but if you've got a parent on a mortgage and they don't actually have a vested interest in it. So let's say they're co-signing for you or you're on a mortgage for that purpose. Um, CRA a couple years ago went in and said, hey, we're concerned about trust rules and beneficial ownership on bank accounts and mortgages on houses as well. And so if you're on a mortgage or on a house on title and you have no beneficial ownership of it, it could be deemed a trust structure, which then could create filing, like additional tax filing. It's generally okay. And they realized that they made a really big mess. And so they've essentially backed themselves out saying, hey, we think it's a trust structure, but guess what? If we don't ask you to file, you're fine. So we assume that it's going to be okay, but it's just like a little asterisk that I would say, hey, for co-signing or have a guarantor on there, it's just something to be mindful that it could show up in the future. Not a big deal. It's not going to be too cost invasive, but it's just something to know.
Okay, great. Two questions on FHSA. Sorry, another one that's come through. Same topic. Okay, with FHSAs, are there penalties if you, for some reason in the future, does not allow you to use it for a first-time purchase?
Yeah. So if you, let's say you put all your money into the first home savings account, you're really diligent, you planned on buying, life threw you a curveball. Maybe you inherited a house, or you know what, you decided that home ownership is just not for you. I have many clients who've chosen to rent, and that's a vehicle or an avenue that made sense for their lifestyle. At that point, after a period of time, your first home savings account needs to be closed out if you haven't used the money for home ownership. And so you have a couple different options. You can take that full balance and shuffle it over to your RSP. No tax consequences. It moves from the first home savings over to your RSP. It can continue to grow, doesn't impact your RSP room, and now it's sheltered for the future. Great. That's probably the best case scenario. The next case scenario is you take all of that money out, but you got a tax refund when you put the money in and you've had growth on that money. Now it's being added onto your income as taxable income for the year that you took it out. So that kind of sucks. So either use it to buy a house or shift it to your RSP, or know that you've got some taxes that are going to be filed in that year. You have to collapse it or you take the money out.
So speaking of the timing with first home savings account, so the next two questions are you may have answered it, so just let me know. So if the question is, if you don't contribute to a first home savings account for a couple of years, and then you can you contribute the whole amount in the next year? Like if you have $24,000 worth of room within 3 years, can you contribute all of it in year 4?
So this, take what I say with a grain of salt, because my platform doesn't offer first home savings accounts yet. So I haven't spent a lot of time digging into the ins and outs, but I did spend some time a couple of years ago looking at it. So this is my understanding, is that you don't start accumulating first home savings account room until you open it up. So you're 18. Great. A TFSA, you start accumulating room whether you have one or you don't. First home savings account accumulation only starts as soon as you open the account up because of that 10-year window. So now you open up the account. Year 1, you put in $8,000. Maybe you put in $3,000. Who knows? You're going to have carry forward room going forward. So 8, and then the next year 16. If you only put in 4, yes, you can top it up the following year. So you've got that room that's going to carry forward for you, but it's just going to only start carrying forward from the date that you open the account.
Okay. So similar but different. This person says, I want to clarify that this account, again, first home savings account, can only be used once for first-time home buyers, or can it be used again after not owning a home for a certain amount of time?
Yeah, that's a great question. So I know RSPs, the first home saving, like the first RSPs, the home buyer's plan, you can use it again if you haven't owned a home for an extended period of time. The first home savings account, I don't think that's quite the case. But let me double check on it. If there's other questions, I can get the answer before we end this. But if we don't, then I'm going to say I don't have the answer, so I don't want to give it.
There aren't any more questions. Do you want to type while I sort of just do my concluding comments and then interrupt me when you're ready? Okay. All right. So thank you to everyone for participating. Thank you, Daneeka. Thank you, Steve. That was amazing. Such great information and very pertinent information for this time. And as you said, Steve, this is the largest financial decision of your life, so you want to get it right. Again, thanks to our affinity partner, TD Insurance, for the generous sponsorship of this webinar. Daneeka, when you have a chance, if you want to go forward with the slides, because I want to talk about some of the upcoming March Madness, let's call it, of TD Wealth and TD Insurance. First, there's Steve's contact info if you want to take a quick picture of it, but we are going to be sharing this with you. So if you want to get any other questions answered by Steve, there's his contact information on mortgages. Daneeka, if you could forward to the perfect, excellent. Okay, so here's another slew of upcoming webinars, a variety of different topics. So our next Tuesdays with TD, which is this is dedicated for University of Manitoba alumni, students, staff, and faculty. Our next one is a month from today, and it's on starting or growing your home business, things that you need to know. So very different topics. So if you're not an entrepreneur, or even if you're just thinking about it or know someone, please share this with them, because there's so much great information that that will be shared in terms of impact on your personal finances and whatnot when starting or growing your business. So I really encourage you to participate. The other two sessions are just being done with TD Wealth widely. So alumni from a variety of universities will be attending these ones, and they're during the day. So on March the 7th, Introduction to Money Management, which is a topic that Daneeka has talked about before, as well as how to build wealth, a similar sort of topic. And all the information is available on our website. If you get our alumni e-news, Have You Heard, we'll also be sharing that, which will be shared next Thursday. So stay tuned for that and register for all of those great sessions. Daneeka, have you found the answer?
Got the answer. Yeah. So for the purpose of opening a first home savings account, you will be considered to be a first home buyer if you did not at any time in the current year before the account is opened, or at any time in the preceding 4 calendar years, live in a qualifying home as your principal place of residence that either you owned or jointly owned with a spouse or partner. So the answer is, if you've owned one before, but it's been more than 5 years, then for the purpose of opening a first home savings account, you qualify as a first-time home buyer. For the purpose of qualifying for a withdrawal, you're considered a first-time home buyer if you do not at any time in the current calendar year before the withdrawal, or at any time in the preceding 4 years, live in a qualifying house as your principal place of residence, either solely or jointly. So the answer is yes, you certainly can, as long as you haven't had a house in the last 5 years.
Okay, great, super. Thanks very much for all of that. Okay, well, thank you, everybody. We're after 8 o'clock. We don't want to keep you any longer. Thank you for your great questions. Thank you for participating. We hope to see you at future webinars, and have a wonderful evening. Thanks, everyone.
Thanks, guys.
Have a great evening.